For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. All right. Oh, I'm excited about today's show. This is going to be great. I'm Johnny Dean, your podcast host. Thanks so much for tuning in. As if you had a choice. You know, you pushed play, so now you've got to listen. Is that how that works?
Do people actually push buttons to say play?
Well, you tap the screen.
Oh,
you know, you got to tap the little triangle on the side. The universal symbol for play. Johnny Dean, your podcast host, here with Professor Rick Plum. Once again, it's Managing Your Financial Future. You are a certified financial planner professional, are you not, sir?
I am, sir.
Thank you for that. No further questions, Your Honor.
Can I be dismissed?
We were just doing my cousin Vinny before we went on the air here, so I've got that courtroom on my mind. Thank you for coming back here, Professor Plum. We're going to call this an inside look at a bucket strategy because you came in and you said, "Hey, I've got an interesting." It's just
the intricacies of bucket strategizing.
Yeah, and you brought up a case that I thought was really fascinating, and I want people to hear about this. And we haven't talked about this before so much. So this is an inside look at what you would do for a bucket strategy. So, Professor Plum, if you would.
Well, it's also an inside look at the options that you can have because not everybody's going to treat it the same way.
Mm-hmm.
And your ultimate emotional status on money has some impact on this too. And we're basically looking at how do we, when we set up buckets, we're setting up, short-term assets, short-term liabilities, such and such. And so we're going to have different accounts, short-term money, mid-term money, long-term money, different investment styles. But what happens when we have his money, her money, and maybe their money? So we got his tax-deferred accounts.
We're talking about a married couple here.
Yeah. Her tax-deferred accounts. And then they've got personal money. And they may have Roth money. If you end up putting bucket number one, where does bucket number one go? We've talked about in the past. Should it be in your IRA, your personal money, your Roth IRA, bucket number two, bucket number three? I mean, if you've got those three basic pools of money, tax-deferred, tax-free Roth, and personal investments that create taxable income right away, you could end up with 9 different accounts between bucket 1, 2, and 3.
Well, because you have two
if
people.
You did buckets if you put all 3 of them, spread it across everything. And that starts to get a little bit cumbersome to oversee and manage for a lot of people.
Well, you have one spouse with, say, let's set this up. Let's set this up. You have a spouse with their own 401k, okay, right. And then you have another spouse who's also been working, and they have also a 401k.
Okay.
So you've got those two. Now, are we saying they have any personal money, or is it just not that much to worry about?
Not that much to worry about in this particular case.
All right, let's keep it simple on that.
So the question comes down to, whose account do we use for bucket number one?
Let's put a number on these. So if you say spouse A has $500,000, I'm just trying to make this easy. Spouse B also has $500,000. So they have roughly, let's say they have roughly the same amount. So now how much income do they need from this portfolio?
Let's just work off general terms and say they need the old 4%, so they need $40,000 a year.
Okay, $40,000 a year, and how old are they?
Well, that's going to be one of the deciding factors, because if they're mid-60s, maybe younger, then we have some options on how to do things. If they're mid-70s and older, now we have less options because we have required minimum distributions from both accounts.
Okay.
And so how do we set up? Does it make a difference? Does age make a difference in this?
Well, apparently it does.
Yes, you read into that very well.
Well, let's start so that we keep this moving. Let's start with, let's say they're in the
older ones. So with the older ones, the people that are already at required minimum distribution age, where they have very similar size tax-deferred accounts. In many cases, we're going to bucketize each person individually to give, in this example, $20,000 from spouse A and $20,000 from spouse B. That will satisfy the required minimum distribution. It stretches it out nicely. It fits within all the parameters of a reasonable distribution strategy, bucket strategy. And so we've got, you might have $150,000, $180,000 of bucket number one in both of their accounts.
Okay, so
and then bucket number two in both their accounts, bucket number three in both of their accounts. So that may be one way to look at it, because they both have required minimum distributions.
Yeah, in this example.
And so that's one of the things we can look at. Now, where it becomes a little bit more complicated, or it gives you more flexibility, more options, let's say they're 63 and they've got 12 years before they have required minimum distributions. And yeah, somebody who's 63 today doesn't have a required minimum distribution until 75.
Yeah. Okay.
Just because of the way ages work. I know it's 73 for people who are in that older age right now.
They know you haven't confused any of that.
Yeah.
75.
So if you're born in 1960 or later, your required minimum distributions start at age 75.
Okay.
So now, should we have 6 different basic pools of money? His and hers, bucket number 1, his and hers, bucket number 2, his and hers, bucket number 3, of equal amounts, taking $20,000 a year? Or, trying to keep things maybe a little simpler, should we have all of either spouse A or spouse B in bucket number 1? All of, or most of bucket number 2 in that same spouses. So we basically deplete one spouse's assets over the next 12 years. And therefore, we still have the same amount of investments. We still have the same amount of bucket number 1, same amount of bucket number 2, same amount of bucket number 3. But instead of splitting between spouse A and spouse B, we end up with fewer basic pools of money we're dealing with.
So let's clarify here. Let's say they're both 63 years old, as you said. They both got $500,000 in let's say a 401k. That's what people understand. All right. So let's say spouse, they need 40,000 a year. So you're going to take all 40,000 from spouse A.
Yeah. Right. There is no requirement to take from anybody.
Right.
So instead of having, let's say bucket number 1 is $200,000. Instead of having 100 of it in spouse A and 100 of it in spouse B, we put $200,000 in spouse A. And we take the 40, it's going to be more than that, but $250,000.
Yeah, okay.
Maybe, take it all from spouse A, and we're going to draw down spouse A's account. So by the time we get out to age 75, by the time we have required minimum distributions, spouse A doesn't have an IRA anymore.
Because you've spent it all over the course of the 12
and spouse
years.
B's money was primarily invested for long-term growth because they had the time horizon for it. We still had the same allotment to bucket 1, 2, and 3. It's just that instead of equal amounts, because they had equal IRA amounts, we've decided to try to lessen the number of investments that you're overseeing and managing to determine, and it makes it a little bit easier for them to manage the style.
So is spouse A, who is going to be providing the required income for the next 12 years, you've put, a bucket 1 and bucket 2 in spouse A, and then is spouse B just strictly bucket 3?
Well, it depends on how the numbers work out, but there might be some amount of bucket number 2 for spouse B, and primarily bucket number 3.
But spouse B in this example is going to have really no non-volatile money, right?
No, they won't have any safe
because
money. They don't need it.
You're not touching their money for the next 12 years in this example.
Right, and we're dealing in this example with people that are very similar in age. So we're dealing with neither one of them have a required minimum distribution. We're just trying to lessen the number of accounts that we're looking that the client has to pay attention to on review and other things.
Keep it simple.
I like the KISS adage. Keep it simple, stupid.
Right.
And so, but that's just for somebody who are the same ages with very similar size IRAs.
How often does that happen?
It happens, but it's probably not the majority.
I got to think that, first of all, you're going to generally have spouses that are a little farther apart in age.
Right.
And oftentimes you have a more of a disparity in how much is in their tax-deferred accounts. You might have one spouse who made a good portion of the money and has,
Well, or it doesn't matter that it may be that they both made similar amounts of money,
but
they set up their financial life where one party, we were living on their income more, and the other party was saving more.
Yeah. So you
you end up with a disparity in the size of the IRA 401k from spouse to spouse, even though they were both equal earners or similar. Or maybe they weren't. But we end up with one spouse having a lot more money in their tax-deferred account than the other one. So spouse A has $1 million in their 401k, and spouse B has $100,000 in their their traditional IRA for whatever
So they've
reason.
got $1 million together,
whatever
something
the number
like
is.
that.
Okay, we can go back to the same example: $900,000 and $100,000, $1 million overall.
Okay, so
a lot of times, what we'll do with that one for that younger person who's not at the required minimum distribution age is that person that's got the $100,000. They're all bucket number 1. We're going to get rid of their account in the first several years of retirement. And therefore, we only have to deal with one spouse's IRAs being split between 3 buckets.
Okay, so to reset,
I'm going to keep it simple,
and I'm going to keep kind of resetting for people. to keep it simpler in their heads for the folks listening here. So what you're doing is you're taking spouse A has $900,000 in their 401k, let's call it, and spouse B has $100,000. So they've got the
and they're getting ready to retire.
They're getting ready to retire. They need $40,000 a year.
Right.
You've got $100,000 in spouse B's 401k. What you're going to do is draw down $40,000 a year out of spouse B's $100,000.
Right, and it'll be gone in 2.5 years.
Yeah, because you're going to put it in something non-volatile, like the entire thing.
We're going to put it in bucket number 1 type assets. High stability, high liquidity. Rate of return is third on the list of priorities.
Yeah.
Stability and liquidity are the higher concerns. And we're going to spend the principal and interest from that account over the next X number of years. Now, if we're taking $40,000 a year out of $100,000, it's not going to last for more than 2.5, 3 years. I don't care how much you earn. You can't have that first priority of stability and get a better rate of return than 5-ish% right now.
No, it's not going to.
That means that the spouse A that had the $900,000, their accounts, they may have 100, 200,000 in bucket number 1, 200,000, 300,000 in bucket number 3, and the rest, or bucket number 2, and the rest in bucket number 3. So it's easier to look and see from an oversight standpoint how to manage it.
So you're getting rid of spouse
B's in this case.
Spouse B's. So spouse B will have nothing left in their 401k.
Don't worry, spouse B. You're still the primary beneficiary of spouse A's accounts.
So even if something happens to this marriage, you're saying
no, nothing. Well, the marriage is a whole. That's who knows.
Let's forget that. Let's forget that.
But that brings up another issue. Some people, from an emotional standpoint, I alluded to this at the opening. They're like, oh, there's no way you're spending all my money. We are not spending all my money to begin with. So in that case, we have to, deal with the personalities involved and say, okay, then we're going to either forget yours. It's 12 years. You're 63 years old. It's 12 years before RMDs. You're all bucket number 3 for now. And we'll spend the other person's money if they agree. Or not. Okay, well, then we're going to try to bucketize your 100. It's harder to bucketize $100,000.
Sure.
Yeah, let's say it's equal yet, 30, 30, 40 between 1, 2, and 3. The account size minimums do matter. You can have better investment options
when you have
with larger account sizes.
Sure.
And so if you're taking smaller accounts and bucketizing it, you're a little more constrained in your options of what you're investing in. So it may be better to say, okay, you've got 100,000, your spouse has got 900,000. We're either using you for all bucket number 3 because you got 12 years for time horizon before you even have to take a required minimum distribution, or we're going to use it all for bucket number 1 so that we can get away from any types of RMD issues, get away from having to deal with these other accounts. Now, back to the people that were 500 and 500, it's a little bit easier to bucketize that because we have a little bit bigger account size minimums that we can deal with.
Okay, so if you did spend down spouse B's $100,000 and they agree to that,
right?
And so they're out of money in let's say 3 years. I mean,
that particular individual's IRA 401k is gone.
Yes,
they're not out of money.
No, you know what I'm saying.
The couple still has the 900,000,
but
growing.
Spouse B's IRA 401k is gone at that point,
right?
Or for all intents and purposes. So you've bought yourself 2.5 years. So that was all it was all bucket 1 money.
Right.
While that 2.5 years, while you're waiting for that 2.5, 3 years, and you're spending out spouse B's money, how would you allocate spouse A? Do you still do all 3 buckets? What would you do with that 900,000?
Yeah, now we're using spouse A's money to backfill what we didn't have already. So if we need 40,000 a year for first 7 years, easy math, what's that? 280,000, not including any earnings. So let's just say 280. If I'm using 100,000 of spouse B's money, that means I need 180,000 of spouse A's money. So spouse A has 180,000 in bucket number 1.
So you're still going to give, because it's not a lot of time, you're still going to give.
Oh yeah, because 2.5 years is not enough for a full bucket number 1.
No,
that's too short.
Yeah,
because if you had 2.5 years at the beginning of 2007 when the market started going sideways,
that's not nearly enough time.
It just had enough money to get to the bottom of 2009. By the time the market got to the bottom, it's like,
you're in trouble.
This didn't work so well.
Yeah.
Same thing if you had 2.5 years worth of money in 2000. That didn't get us very far. We were still in a very negative position. And why is that an issue? Because now I'm selling assets out of bucket 2 or 3 that have potentially gone down in value. And the one thing I don't ever want to be put in a position to do is sell assets that are down to create current cash flow that I knew I was going to need.
Yeah.
So bucket number one is more than 2.5 years.
So even though you're not touching spouse A's retirement savings in this particular example.
Not for 2.5 years.
Yeah, for that 2.5 years. You are still prepared. You are not going to put spouse A all in.
No, we're bucketizing the couple.
Exactly.
The couple says we need $280,000 in bucket number one. Call it $300,000 in bucket number two, and the rest of it's in bucket number three. Now it's just a question of, do I do 140 and 140? Well, no, I can't do that because he's only got 100, in spouse B. So let's take 100 of his and do the 180 of bucket number one in bucket number one, and then the rest falls into where we are. We still have the same overall allocation. It's just which accounts do we use where? And trying to reduce the number of accounts, trying to reduce and make life a little simpler for that individual so they have a better grasp and understanding of what's actually happening. Yes, in cases we may spend all of our... We do this a lot also where we have people that inherit IRAs, beneficiary IRAs.
Oh.
Where do we want to stretch it out forever? I mean, maybe you inherit it before 2020 and you have that stretchability. Maybe you inherited it from a sibling who was less than 10 years older than you, and you have the ability to stretch it over your life expectancy. Should you stretch it over your life expectancy, or should you treat it as part of bucket number one and be done with the separate RMD calculation before you get to your own RMD, or at least as quickly as possible afterwards?
Is everybody following that? I mean, I'm listening with rapt attention, so I'm following it. But here's
all of
the
these
thing.
different types of accounts may be something you have to deal with. You have your IRA, you have your spouse's IRA, deferred accounts. And now you have a beneficiary designated account, a BDA beneficiary IRA. How do I invest these things? And how do I invest them also depends on, is that a beneficiary IRA or a beneficiary Roth IRA? Yeah.
Well, the Roth part of it does make a difference,
especially on the beneficiary side.
Absolutely. I mean, you've got the tax-free nature of it changes the character of it.
Do I want to leave, even if I can wait the 10 years, which not many people necessarily can anymore, because a lot of people have a 10-year rule. All the money's got to be out of 10 years.
Right.
With a traditional IRA, do I leave it alone for 10 years and then take it all out in one lump sum?
Taxable.
That can be somewhat taxing. That can be somewhat hurtful to your tax return. On the other hand, the Roth IRA, if I inherit a Roth IRA now, I am subject to the 10-year rule, but it's going to be tax-free. I want to get the biggest tax-free bang for the buck I can get. Yeah. I'm going to let my beneficiary Roth IRA, if possible, if I can avoid not having to take any money out of it, grow for 10 years, take it all out December 30th of the 10th year so that I got as much potential growth tax-free as I could out of the beneficiary IRA. So how we treat it in a bucket is different because it's all part of the overall strategy. Yes, there's different types of accounts. Yes, there's different rules regarding taking money out, not taking money out. We have to build those rules or use those rules in how do we allocate the buckets once we've identified how much money should go into each bucket, and then just make that picture a little more crystal clear.
It's just all part of what was this saying? You plan, God laughs. Whatever that was.
That's a new one to me.
Well, plans. You have plans, but the universe will always throw a wrench in somewhere.
Well, I just I heard all the best laid plans go to Hector Hannibasket once the first shot is fired. So
Well, yeah, it all kind of means the same thing. In other words, you can make plans, but count on those plans being altered at some point by something out of your control. And
that's why a bucket strategy has to be able to be flexible,
absolutely,
and grow with you. And I'll tell people this, especially when they're just getting ready to retire, and they're saying, "Well, you think you need X, but until you're actually in retirement, you're not sure that you need X amount." It's a transition period, and so you want to probably be a little more conservative at the beginning because a lot of people end up spending more than they thought, at least in the early years of retirement. So maybe if you think you need 40,000, plan on 50 or 55. Then give yourself that transition period so that you can really decide what retirement looks like for you without the market telling you can or can't do it.
We talked a while back, and we've said this before, off and on. about the importance of having room for error is what it is. If you've got room for error, for things going wrong, things not going according to plan, where if you're not flexible, or if you don't have if you don't have the ability to be flexible, like my stocks cannot lose money for the next 3 years. I'm sorry.
Well, then you're
they
in
cannot.
trouble.
You're in trouble.
They can.
You're no, but
I'm not saying they will. But
I'm putting this money in, but I can't lose money. I gotta have it. Well, that's just wrong. You're courting disaster when you do that.
You're courting an ulcer.
It may work out great.
Oh, good. Yeah.
You might have done this in 2012 and said, I need this in 3 years or 15.
Yeah.
And it worked out great. But again,
if you
you're
did
gambling.
It in 2006, you weren't happy.
You weren't happy. So
you did it in 2001? Yeah, we'll see.
But it shows the importance of having flexibility that you mentioned.
Flexibility is important.
Because things happen to people.
Right.
Expenses happen, but good things happen too. Now, how would you do this? If you had the two couples, each with $500,000, okay, back to spouse A and spouse B, each with $500,000 401ks, let's say.
Right.
And spouse A has a, relative that dies, and they leave them another $500,000 in an IRA.
Okay.
Let's say. Does that become
so now we do a buckets plan on $1.5 million. They used to have $1 million. Now we do a buckets plan on $1.5 million, and we identify how much money they can spend, because they were looking at retirement spending, $40,000 a year, but now they're saying, we got this extra money. Do we blow it as a lump sum and buy a vacation home in Vail? I don't think you can do that for $500,000. Or do we just increase our everyday income or our ability to have everyday income? And so that's a discussion.
Is this
first.
money now commingled though? I mean, it went to spouse A.
It depends on the spouses.
Yeah.
Because some spouses say, no, this is not, we're going to just take the RMD and we're going to put it in a separate account. We're not going to live on this, and it's going to the kids.
Yeah.
Or it's going to my kids from a previous marriage, or whatever the case may be. So obviously that's the first discussion. What is this money for? I had a discussion with somebody this morning. They were talking about selling their house and what are they going to do this? I go, what do you, they don't have any heirs. They don't know what do you want this money to do for you? What is this money's purpose? Let's find out what it is we're trying to achieve. And then you invest accordingly. So let's assume that they say, yeah, we want more income. We want
to live better.
We want to, we want to fly at the front of the bus instead of the back of the bus. And
fly on a bus? That's an interesting concept.
I want to fly front seat. Well, can't fly front seat, but
you want to get on that. You want to get on that.
I want to be in the first couple rows.
You want to call shotgun, right? With when you get on the plane.
Or whatever.
Although, please don't yell shotgun when you're getting on an airplane.
Oh,
please.
Gosh.
Okay. All right.
And don't yell hi to your friend Jack either.
Don't do that. Stop. All right. We're having fun. Okay. But
so we've identified that they just want the ability to increase their income. So now we're going to look at it as $1.5 million pool. We started with them before looking at $1 million pool, and they wanted 40,000. So we were going to do, we came up with the allocations based on that need. Now they're saying, well, let's do 60,000. So we do that. We do our allocations based on that need and that pool. And now we've identified that bucket number one should be $320,000. Where do we get bucket? Now we go into, okay, where do we get bucket number one from? And in that particular case where they just inherited $500,000 and it's going to be commingled, they've already decided that. To me, that's their bucket number one. We're going to spend that money first and be done with it before they ever get to their required minimum distributions. They're going to be taking $60,000 a year out of tax deferred accounts anyway.
So all of this, you've got flexibility, you've got the ability to,
and you've got the ability to rework it if you set it up one way and then things change.
So the idea of buckets, of course, is to get them supply enough income that they don't have to worry about what happens in the stock market.
Enough cash flow, yeah.
Could you at all do this with somebody who's trying to do the tradition? I don't want to say traditional because it's really not, but I guess it is. The 60-40 stocks. Yeah, let's just take systematic withdrawals.
Could I do it that way? No, I will not do it that way.
What makes buckets better? In other words, to do it to how does
better
buckets
is relative as well, because better assumes that in in any type of occurrence you're going to do better. The reality is buckets. I've run lots of different scenarios, simulations, and everything. comparing a balanced portfolio distribution method to a buckets distribution method. And if there's negative time periods, I've been able to blow up a buckets plan.
What do you mean?
Run out of money by adding excessive spending here or crazy inflation there. But in every case where I blew it up and I compared it to a balanced portfolio, it still lasted longer than the balanced portfolio.
Now, when you say that, you're saying blow it up, meaning you ran some numbers to see what would happen.
Scenarios that were just outrageous.
You're not doing this for anybody.
Not for a client. I'm doing testing in my own world. Doing statistical testing.
Of course, if you spend too much, you're going to run out.
And doing the exact same scenario, whether it be inflation or spending, between a balanced portfolio distribution and a bucket strategy distribution. And in every situation where I was able to bankrupt the bucket strategy, the balanced strategy was bankrupt sooner. So the buckets always lasted longer in those negative times. On the other side, where the market did nothing but up, where the market never had bad days, where everything was golden and rosy, the bucket strategy did not keep pace with the balanced portfolio strategy.
Well, it's not. And that's what we said before. If you've got the traditional balanced portfolio, systematic withdrawals, take a certain percentage out and rebalance every year, if you did that, it could work beautifully if the markets never went down.
Right.
But I checked, and the markets
they go down once in a while.
Sometimes more than once in a while, go down.
The question between those two strategies, which is more important to you? Surviving longer with bad news or having a little bit more money with great news? And most retirees would rather last longer. It comes back to the plan for the worst and pray for the best.
Well, you know what they say.
If you can make it work under the worst scenarios, then everything else is just gravy.
Well, that's true. They've run studies and they've done mathematical models, and they've found that people with pretty good returns, not stellar, but pretty good returns, lasted longer and had more money than those who every so often hit a home run. You know what I mean? People who shot for the stars and hit it every once in a while, but of course had some real bad runs.
And this is assuming they're also taking distributions at the same time.
Well, yeah, that's
because
along those
distribution
those
strategies change the way you should be investing.
Because you're taking money out.
Right. Volatility is not working for you at that point. It's working against you. When you're putting money in, volatility is potentially helping you.
Sure.
When you're taking money out, volatility is going to work against you.
Well, think of all the people who have been doing their 401ks faithfully all through 2022 as the markets were going down.
I know that statement's bad. I don't even want to look at it.
Well, but look what they were doing. You just invested through it. You used that volatility so that when the markets did come back, as they did, in fact, they're
well, you bought a bunch of shares on sale in the bad times,
and those shares that you bought cheaper, you have more of them working for you as the market has come up.
I was speaking to a 32-year-old this morning who's got maybe $40,000, $50,000 in their 401k, and they moved it all to safety and their ongoing contributions to basically the bank accounts inside their 401k because they got us scared.
Speaking
were
of
afraid.
Joe Pesci,
yeah. I said, well, you understand that's a mistake, right?
This was a 30-something-year-old?
32, I think, 31. They're young 30s.
They've got 30 years.
Right, but they didn't like seeing the account balance go negative or go down.
But it was a mistake.
I said, the reality is, and he's maxing out his 401k now. He's making good money.
Wow, good.
He's doing, he's putting the 20+ thousand in every year. And I said, the reality is that 40,000 that you have in your 401k is a small piece. The reality is when you're 60 years old, that 40,000 is going to be a very small percentage of your overall pie. The majority of your future nest egg is going to come from the 20,000 plus you're putting in every year for the next 20, 30 years. What's going to matter.
The contributions.
Yeah, the contributions that you're putting in. And you get paid every week, every 2 weeks, every, whatever it is. You're buying. You want that volatility. That 30-year-old has a completely different hope for the market than me as a not 30-year-old, not even close, has for the market.
You've more than doubled that. 30.
Shush up.
That's what you've done.
And you're right there with me.
I have doubled it, but you've more than doubled it. Yes. Well, that's true. So
he wants, in reality, he wants the market to go down and stay down for a while. so that he can buy as many shares as possible while it's down.
Yeah.
Before it comes back and he makes money. I, as somebody who does not want to, lose money, because I've done the majority of my building of my portfolio through my ongoing contributions and savings. I don't want it to go down.
It's going to go down.
It's going to.
But you have to be ready for it.
The money I need in the next 10 to 15 years should not be anything that can go down that much.
Yeah.
We have different goals for the market, but the market is the same, and he can't manipulate the market, and I can't manipulate the market, so we have to then plan our strategies differently. That's why target date funds stink to high heaven for this particular purpose.
Well, that's true, and we've done shows on that too. Maybe
and that's why he should be embracing the volatility.
And what? Pedal to the metal and the thing to the floor?
Yes.
Yes.
Thank you, Miss Fields.
Yeah, I'm here for you. This is what Buckets attempts to address. So I wanted to do this. I thank you for this, Professor Plum, because I wanted to do this inside look. This was kind of an inside look at what you would do on a bucket strategy, and you're basing this off of one that you
have lots of factors that are going to change from one person to another person. The emotional attachment to their funds, the ability to spend, the size differential between the two spouses, the age differential between the two spouses, where their starting point is now. Are they already at RMDs? All of these seemingly very minor variables come into play, and they change. They don't change the bucket strategy as much as they change the location strategy, which is part of the bucket strategy.
You want to know more about buckets? If you don't know enough already, if you're not bucketized and you're close to retirement, probably a good idea to talk to the advisors at Lucia Capital Group. We've been partners with them for decades, and this continues. 800-644-1150 at Lucia Capital Group, 800-644-1150. Professor Plum oversees all of the financial planning. What are you, Chief Financial Planning Officer?
That's a title.
That's good. What is that? CFPO? That's not
C3PO.
Turn the F around. So yeah, but that's what you are. You oversee all these plans, but you guys meet all the time as advisors, and you discuss these strategies.
We do, and we discuss different investment options within the buckets, different tax planning issues, value averaging issues, laws changing. RMD laws have changed quite a bit in the last couple of years, beneficiary RMDs and things, and so we have potentially some tax laws changing in the next couple of years. We'll see what that does.
Well, and that's something
we're always trying to stay up on top of all those changes.
Exactly. And so you're in there at least once a week that I see the whole group of you out there. So give them a call, 800-644-1150. They're all on the same page, and they can help you out. You want more on this information? Boy, there's a ton of it on our website, luciacap.com, LUCIACAP.com. You can find past videos that we've done. You can find blog posts and white papers and all that stuff. All the information you need there at luciacap.com. Spotify and Apple Podcasts, where you find this podcast. It's where you found it. You pressed play and you left it alone. That's good. You've heard us all the way to the end. See how much information there is? This is just, I always feel like I hope people are feel a little smarter after they listen to the podcast. If you don't, let me know. Okay? And if there's a topic you'd like us to cover that you think might be good for everybody to hear, or if you have questions about buckets or any aspect of this stuff, you can go to luciacap.com, find your answer, and click it there, and we will get that. We do get emails from listeners from time to time. Professor Plum, thank you again so much.
You're welcome.
Taking time out of your busy day. For Professor Rick Plum, CFP, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. Thank you so much for listening. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should also always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to buy or sell any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Before investing, carefully consider a target date fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. A value averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.